what drives the various parts of the bond market, what drives the various maturities, if you like, from between the short end, the belly of the curve, and then obviously the long end. Now, to help me, I've just taken a couple of slides from one of our 30-day challenges, which explains a first important concept that we always need to keep in mind about the bond market, and that is the difference between primary and secondary markets. So when a government or a corporate wants to issue new bonds, it first get issued in the primary market, where retail traders and investors like us won't have access to that first issuance. That normally goes to big funds and hedge funds, pension funds, mutual funds, etc., maybe other governments. So the primary market is where you get your first issuance. Now, it's important here to understand that when a bond is released in the primary market, it gets a fixed coupon rate. That means that you can only receive that same fixed income for that bond until the maturity. So the coupon doesn't change. So let's just say that you are buying a government bond for $1,000. Just hypothetically speaking, let's say you're buying it for $1,000, and the yields at that stage is currently, let's just say it's trading at 2.1 or 2.2%. And let's just say for various reasons, whether that is premiums being priced in, other transactional costs being taken into account, let's just say that your coupon gets fixed for that bond at 2%. That means that for the majority or maturity of that bond, that whole life cycle, let's say it's a 5-year bond, you can only receive 2% as a coupon payment per year for the maturity of that bond. Now, once a bond has been bought in the primary market, it is initially or immediately considered to now be in the secondary market, which means that the moment when that first person buys it, again, whether that's a hedge fund or a bank or a mutual fund, etc., then they can now decide to go and trade that in the open market, in the secondary market. And that is where you will, where various bonds is traded as any other security, like an equity, etc. So this difference between these two markets is very important, because if you understand this, you'll understand why things like interest rates and yields, or inflation rather, why it affects the bond market the way it does. So if you take a look at this screen here, this tells us a first very important part about bonds, and that is that inverse correlation between the price and the yield. So if the price goes up, we know the yield goes down. If the price goes down, we know the yield goes up. Now, the primary and secondary market understanding comes in to understand exactly why this happens. So let's just say, hypothetically speaking, that you bought a bond for $1,000. Your coupon for that was 2%. That means that you get a $20 coupon payment on that $1,000 bond per year. Let's just say it's a 5-year bond. Now, let's say in the meantime, let's say you bought it year one, and let's say sometime in the middle, suddenly inflation starts to rise, and that sparks expectations for interest rates that'll rise. Now, we know that yields are linked to interest rate expectations, right? So when that rises, we see yields rise as well. Now, when that yield starts to rise, now the problem is, imagine that you have a new issuance coming in the primary market. That new issuance will now obviously get its own fixed coupon rate. But what now happens, what will happen to your bond that you bought for $1,000 if that new bond that gets issued is now suddenly issued at 2.2% yield? For you now to compete with your $1,000 bond at a 2% coupon, you need to lower your price to $900 for that bond to give you the same type of yield comparison. So for your bond to stay competitive, the price needs to fall, right? i.e., bonds lower, yields pushing to the upside. So understanding this dynamic explains why things like inflation and rates are so massively important for the bond market. Because if you are buying that $1,000 bond right now, but inflation is set to rise drastically in the next couple of years, it means that $20 that you bought or that you get per year, that coupon, that $20 gets eroded away more and more every year as a result of inflation. So if inflation is expected to rise much faster than your coupon, then obviously there's going to be you're going to have trouble trying to sell and trade that bond, and obviously it means that fixed income investment that you have, it's worth less and less every single year. So that's why things like inflation and how inflation impacts short-term interest rate expectations, why that is so crucially important for the bond market, and that explains that economic logic, that mechanism for you, is that it's about if yields are at this level, let's take a look at this chart. With yields at this level, what does that mean for all the bonds that got issued at lower yield levels? That means that for them to stay competitive in the secondary market, the price needs to drop for that yield to push to the upside. It needs to stay competitive, right? So that's the first important thing to understand about that mechanism. So when you've got higher inflation and that sparks expectations for higher interest rate, that moves the yield up. Now, it's important to understand that when that happens, when interest rate expectations shift like that, you get yields pushing up across the curve. So you get all your yields from all the various maturities pushing up across the curve. So you get a much steeper curve compared to prior curves where the markets are pricing in much lower rates or much lower yields, of course. So when there's expectations for higher rates, you see the entire curve rising across the board, which means that you see your 3 month up, your 1 year, your 2 year, your 10 year, your 3 year, all those yields will start to rise as rate expectations start to rise. So, unfortunately, I can't do it on this chart, but if you were to look at this current yield curve and you compare it to where we were just 3 months ago, we had a massive steepening change, a huge move to the upside. So, if I can draw on this, you would have seen that prior curve being much shallower, much more flatter compared to the one that we have right now. So it does move up across the board, but even though the entire curve can move up and down as interest rate expectations change, the various parts of the curve is also in itself driven by various factors. So the shorter you go in your curve, so anything from a 1 month up to about a 1 and a 2 year, even your 3 years, is very sensitive to short-term interest rate expectations. What is the Fed going to do next? Or what's the ECB going to do next? Or what's the BOE going to do next? So your short end of the curve is normally driven mostly by short-term interest rate expectations, whether they're going to hike, whether they're going to stay flat, neutral, or whether they're going to cut. That's why you see in the front end of the curve, you've seen that massive steepening, but at the long end of the curve, you're starting to pan out, you're starting to actually invert to the downside the longer you go out. Now, the reason why that is, and the reason why we still hold to a medium-term downside expectation for yields right now, is because in the medium term or the long end of your curve, this at the back end is driven by growth and inflation expectations. So think about the 10-year as your measure for what the markets is saying growth and inflation will look like in 10 years' time. What will growth and inflation look like in 20? What will growth and inflation look like in 30 years' time? So that is really your barometer for the medium and the long-term economic outlook as opposed to just the rate outlook. So there's obviously premiums built into yields at various maturities, which means that even though the growth and inflation outlook might be worse or better, those premiums need to be taken into account with how that yield is currently priced. So there's a lot of additional things priced into a treasury yield as opposed to something like a OIS yield curve, which will be slightly different because there's far less premiums. It's seen as a cleaner curve, if you will. So if you go back to this chart, let's look at a couple of examples that we had. When the Fed, just after the financial crisis, obviously rates dropped down to the lower bound. We saw both 2s and 10s pushing to the downside. But what you'll notice from this chart immediately is how closely the 2s track the effective federal funds rate. And what you'll also notice is that normally the 2s will lead the market, right? The markets doesn't move up when the Fed finally starts hiking rates. The markets will move up in anticipation that the Fed is either going to cut rates or hike rates. So over here, you'll see back in 2003, 2 started to push up way before the effective federal funds rate moved up. 2 started to plummet back in 2007 before rates were cut. Similar story back in 2015 and 14. 2-year yields started to rise with the onset of the taper tantrum. So the markets are starting to price in higher rates. You can see that by the 2-year yield. But what I want to show you here is this divergence between these two, where even though the short end was pushing to the upside in anticipation that the Fed is going to hike rates, 10-year yields started to push down drastically back in 2014. And this is really the type of situation that we're looking at right now. And the reason why we saw that happening is that despite the fact that the market still believed the Fed was going to hike rates, The medium-term growth and inflation expectation took a massive beating back in 2014 because we had growth slowing at that stage. There was a couple of crises hitting. We had oil prices actually falling, not rising like they are right now, but we also had a massive push lower in oil prices. There was growth concerns coming out of various places in Europe. There was a real concern in the global economy at that time, with growth slowing, inflation slowing as well. So it's always important to understand that when you are looking at bonds and yields, not to look at just one specific maturity, but to make sure that you're looking at the right maturity. So in our case, we're expecting 2-year yields and have expected 2-year yields to continue rising throughout the year, but we didn't expect 10-year yields to rise as much as they have, because based on where we think the economy is going, based on where we think growth is going, we would have anticipated to see 10-year yields much lower already. Now, if you plot something like CPI on a chart going back a couple of decades, if you plot that alongside twos and tens, there is obviously that big correlation between yields at various ends of the curve with inflation. So the fact that inflation is 8%, I think, is the only reason why we haven't seen the long end of the curve pushing lower. And that's also why I keep saying that as long as this thing, as high as this thing keeps pushing up and up and up and up, it means that the move to the downside is going to be more aggressive, because the bond market will only be able to price in so much for growth in inflation until it swaps to the other side, like we saw what happened back in 2018, where it was just great, everything was great, it was going good, and then suddenly the bond market realized, wait a minute, growth is slowing, inflation is expected to slow alongside that, and the Fed is expected to hike rates aggressively and quote unquote stay on autopilot. That saw bonds pushing, or bond yields pushing lower drastically, not just the tens, but across the curve. Because at that stage, it wasn't the case of the Fed is going to keep hiking rates. The markets across the curve was pricing in, they're probably going to start, they think they're going to hike 4 times in 2019. They're probably going to start cutting rates in 2019. And lo and behold, back in July 2019, we saw the first rate cut taking place for the Fed. So when you look at the bond market, think of it in terms of that dynamic of why do rising inflation and rates impact the curve the way it does and impact yields the way it does. It has to do with primary and secondary markets, that inverse correlation between the price and the yield, and how prices needs to change to basically mirror what's going on with yields. And then on the other side of the question, why we think it's moving lower, I don't think twos necessarily is going to move much lower, because the markets are still pricing in hikes. And we do think they continue to hike. But at this stage is a question of how far are they going to hike until they break even more things, because the growth picture is already slowing right now. We've been looking at a couple of data points. Even though things like your labor market has kept fairly strong, and you've seen many Fed members coming out over the past couple of days saying, the labor market's so strong labor market, such a strong labor market, a great labor market. But that's a late cycle indicator, right? The things that matter for growth isn't just the labor market, which is a late cycle indicator. It's what's happening to personal income. It's what's happening to personal consumption, what's happening to retail sales, consumer sentiment, industrial production. All of those things have been clearly slowing at a fairly rapid pace as well. So that's why, in my opinion, I think yields move lower in the medium term. I think the one thing that's caught me out on the long side has been the fact that if you asked me 2 months ago whether I thought that inflation would be 8%, I would have said no, because I wouldn't have thought that Russia would invade, right? There wasn't expectations that inflation or commodity prices is going to do what they did. So there's a lot of things that happen in between, but even though those things have in the short term pushed up yields even more aggressively and turned the Fed even more hawkish, I think the higher that goes, the higher the probability becomes that yields will need to reverse. And when they do, I think it's going to be a nasty business to the downside. But the thing about having a macro view like this is that you need to listen to the price at the end of the day, right? We haven't been wearing losses on the yield front from the start of the year. We've had 2 trades that we've taken in terms of in terms of the bond market. The first one worked out great. The second one didn't. We've taken a couple of gold trades, a couple of dollar yen trades, but because the markets have been moving the way it hasn't been a very easy one to trade. It's been one that's been moving against that medium term expectation based on the short term drivers that we've had. So I hope that explains that mechanism that you're looking at, and also explain why at the long end of the curve we still expect that to move lower. I mean, if you take a look at something like the spread, the yield spread between tens and twos and fives and 30s, I mean, you can see that the market right now is definitely pricing in higher chances of lower growth. The market is looking at this saying, they need to be aggressive right now because inflation is high. But what cost will we need? What cost will we need to pay with this recent reaction we've seen from the Fed? And that's really where our focus is right now. So hope that helps, Rob. As always, any other questions, don't hesitate to let us know.